Hello, everyone, and welcome to our monthly review of the economy. Since we last spoke, risks have only multiplied. On a positive note, Omicron proved to be much milder than expected, and this we thought would create some upside to our growth outlook. But that did not happen. It was very quickly replaced by rising geopolitical tensions. The Russia Ukraine conflict has created an upside to global inflation and a downside to global growth. And all this has implications for India as well. Rising inflation, particularly in advanced countries, means that they will move much faster on interest rate hikes. We believe US is on course to 6 interest rate hikes beginning March this year. And all this will have implications for India. And today's discussion is on how all these developments impact our GDP growth, our inflation, and our external accounts. Let's begin with growth. We have retained our GDP growth forecast for the fiscal year 22-23 at 7.8%. This forecast was first made in the month of December 2021. As I was pointing out earlier, there was some upside to this growth number because Omicron proved to be mild, and we expect the Indian economy to enter into an endemic stage of the pandemic. This would have created some upside to growth. Now that has been very quickly shaved off by the geopolitical tensions that are on the rise. So as an interplay of both these, we expect GDP at 7.8%. This is as per our current assessment. I must point out that the risk to this outlook is firmly tilted downwards. We have revised up our inflation forecast to 5.4% for the coming fiscal year. This assumes crude oil to settle at $85 to $90 a barrel in the coming fiscal year. Currently, the crude oil is at a much higher level. We expect them to soften a bit. So that is our base case assumption. Even if oil rises to $100 a barrel, we don't expect the overall consumer inflation to cross 6%. Last time the consumer inflation was close to 10% or double digits was in 2012 to 2014 period. At that time, crude was averaging around $110 a barrel. Food inflation was in double digits, and core inflation was close to 9%. This time around, although the crude is at a higher is rising, but the core inflation and the food inflation are much softer in comparison. The food inflation is benefiting from the bumper harvest that we got. Despite some pressure on the edible oil, we expect food inflation to remain soft. And I think as a consequence of that, the inflation will be higher than what the central bank expects, but it is unlikely to cross 6% as per our current assessment. Now, what does it mean for the central bank action? We expect the RBI to raise interest rates by at least 50 to 75 basis point in the coming fiscal year. In the April policy, they will signal a neutral stance, and I think gradually, they'll prepare the markets for rate liftoff, and we should see first the reverse repo rate hike followed by repo rate increases. And finally, on the external accounts, we expect the current account deficit to rise to 2.2% of GDP in the coming fiscal year. Now, this will create depreciation pressure on the rupee, which we now expect will settle at around 77.5 to the US dollar by March 2023. We have a very good forex shield this time to support the currency market, but the shock that is coming is also very large and very unpredictable. So we should be prepared for a huge amount of volatility in the currency market. Now, the global situation is extremely fluid. We will keep our eyes peeled for these developments and come up with a reassessment in the month of April. Until then, goodbye.